Good morning everyone, my name is Gianluca Santi and I'm the General Manager of Business Development and Corporate Communication of the Unipol Group. Today, before presenting our preliminary annual results, I would like to comment briefly on the past year's goings-on, which had dire implications on the lives of people around the world. It's against this backdrop that our group has reinforced its sense of responsibility and has done its best to be close to the stakeholders, providing economic support and social aid. Priority was given to health protection and safety, while ensuring operation and preserving profitability. Given this dutiful premise, allow me to return to our core business that, under the circumstances, showed a very good overall performance in 2020. In this presentation, I'm focusing on the result pertaining to the financial year just ended. Let me share with you some key messages that outline the Group 2020 results. Results improved. Normalized pre-tax profit went up by 11% at Unipol level and by 15% at UnipolSai. Solvency ratios remain solid even after dividends deduction. Unipol plus 27 percentage points and UnipolSai plus 25 percentage points year on year. In the asset allocation, we increased the diversification during the year, when the exposure to Italian govies was reduced by 8 percentage points on the total portfolio and debt to equity by 30%, in favor of euro area core govies, high-rated corporate credit and real assets. Dividends proposal entails an increase of our shareholders' remuneration. 28 cents is the DPS for Unipol, that is plus 56% compared to 2018, the last year of dividend distribution, and 19 cents for UnipolSai, plus 19% year on year. Let's take a look at the consolidated results. I would like to tell you briefly that, as you may know, both Unipol and UnipolSai subscribed to the BPER right issue in full. However, due to the exercise pertaining to 81 instrument, the resulting stake of the Unipol Group is now equal to 18.9%, slightly diluted compared to the pre-money stake of 19.7%. This led to a review of the previously calculated badwill, thus implying an accounting impact of about minus 41 million on the profit and loss, namely 20 million in the non-life sector and 21 in the holding and other sector. This, however, did not affect UnipolSai results. Unipol normalized pre-tax profit, net of this accounting item, showed a good growth to 1,066 million at full year 20, from 962 million for full year 19, especially owing to the good performance on non-life business, which more than offset the decrease recorded by the life and the holding and the other sectors. The normalized consolidated net result was 905 million, 24% higher than the previous year. This figure at UnipolSai was 853 million, showing an increase of 18% compared to the same period 2019. Looking at the actual results, including the negative extraordinary accounting item, Unipol consolidated net result at full year 20 was 864 million. As I mentioned earlier, at UnipolSai the normalized and actual results were the same. Total non-life premiums decreased by 3.5% year-on-year to 7.9 billion. Motor premiums fell by 4.6%, mainly due to #UnMesePerTe, the campaign launched by the group implying a discount for its motor customers and linked to other support action against the pandemic challenge. A slight decrease has to be mentioned in non-motor premiums too, 2.3% compared to 2019. Looking at the three ecosystems, Mobility recorded a minus 4.2%, welfare a minus 2%, and property a minus 3%. No significant changes in the distribution channels, with agents retaining their leadership and collecting over 80% of the total income. Combined ratio after reinsurance was 87%, a significant improvement over the previous year, including an impact of 6.6 percentage points from atmospheric events and heavy losses. In 2019, reinsurance offset a considerable part of the effect of weather events, while in 2020 the decrease of this kind of losses, along with some changes in treaties, allowed the group to cover a smaller part of these losses. Combined ratio of direct business stood at 85.4%, with an effect of 7.3 percentage points from atmospheric events and heavy losses. In motor TPL, combined ratio of UnipolSai SPA stood at 83.4%, declining by more than 12 percentage points and reflecting the trend in claims reported and frequency. The decrease in the average premium, 7.3%, is mostly due to the implicit discount in the #Un mese per te campaign, which, on the other hand, helped to further raise the excellent retention rate. Savings on settled claims remained on a very high level, 46% in motor TPL and 67% in general TPL. In life business, total premiums declined by 26% to 4.3 billion, in line with group's strategy, which aims not to increase income but to limit yields dilution, keeping them steady. Let me add that the last year production included a one-off item linked to the pension funds for over 600 million. Excluding that, the drop in premiums would have been around 17%. In terms of products, unit-linked recorded a strong surge in 2020, and hybrid products showed a constant increase, still representing what the group is focusing on. Let's now dig in the life yields. The slight drop in the average segregated accounts yield is the result of the de-risking activity carried on in the financial investment portfolio. Even so, the gap between average and minimum guaranteed yields remains large at 203 basis points. The composition of guaranteed yields across the backbook is constantly improving. In this respect, let me underline that nowadays about one-third of our technical reserves refer to a 0% minimum guaranteed yield. Total investments were 62.2 billion at market value. As previously mentioned, in the asset allocation, the strategy that the group has been pursuing consists in reducing its exposure to Italian BTPs and equity, in favor of euro area core govies, high-rated corporate bonds, and real assets. As a consequence, on a year-on-year comparison, the weight of Italian govies fell by 7.9 percentage points to 42.2% from 50.1% of the total portfolio. Equity decreased by 30%, reaching 2.5% of total assets, while other asset classes increased in their incidence, in particular non-Italian govies plus 4 percentage points and corporate bonds plus 5 percentage points. Financial yields remain solid with an overall return of 2.9%, of which 3.1 life and 2.6 non-life, affected by the aforesaid de-risking strategy in the last part of the year. The duration of the assets was 6.8 years, 3.5 in non-life and 8.4 in life. The book value of the real estate portfolio was 4.1 billion, of which 2.9 for third parties and 1.1 instrumental and shareholdings. Focusing on the third parties portfolio, gross yield in 2020 stood at 2.9%, despite the renegotiation of some rental agreements following the crisis related to COVID-19, which negatively impacted by 1%. Let's now turn to the NPE business. In a difficult year, Unipol Rec lessened its gross loans by 419 million, with collection of 116 million compared to 110 million in 2019, maintaining a satisfactory recovery rate of 28%. 423 million was the amount of net bad loans at the year-end, covered at 86%. Over the period, the company was able to realize a net profit of 6 million, while lowering the debt level to 73 million from 155 at the end of the previous year. Since its start, the company has collected 321 million. As you know, Unipol didn't pay dividends in 2020 in order to comply with the prescription of regulators. Today, we propose a dividend distribution of 28 cents for Unipol, plus 56% compared to 2018, and 19 cents for UnipolSai, plus 19% compared to 2019. This is consistent with a payout of over 60% for both Unipol and UnipolSai, as calculated on the basis of estimated local GAAP results. In terms of solvency, the ratios at both Unipol and UnipolSai went on improving strongly, despite the fact that they factored in the total dividends the companies will distribute. The ratio for Unipol, using the partial internal model, was 214%, increasing by 27 percentage points over the full year 19. UnipolSai consolidated ratio on an economic capital basis was 277%, plus 25 percentage points, and UnipolSai solo ratio, using the partial internal model, stood at 312%, with an improvement of 28 percentage points. Looking at Solvency II components, Unipol own funds amounted to 9.2 billion, of which 6.6 billion were Tier 1, while the solvency capital requirements were 4.3 billion. UnipolSai consolidated own funds were 9.6 billion, with Tier 1 for 8.4 billion, while solvency capital requirements amounted to 3.5 billion. Well, I conclude my presentation here. I remind you that the Group CEO and General Manager will be pleased to take any questions from financial analysts and institutional investors during the conference call scheduled today at noon CET. Thank you for listening and take care.